It's almost the first Friday of the month, which is usually a big day for the markets. It's when we see the release of the US non-farm payrolls data. Even in a normal month, NFP can be quite a volatile one for the markets. But with rate cuts supposedly only a couple of Fed meetings away, that puts even more spotlight on this month's release, particularly after what happened last month. To keep it short, it was a bit of a mixed bag. The establishment survey, which gives us the headline NFP number, showed a strong labour market. The number of new jobs was 272,000, which is a lot anyway, but was also almost 100,000 more than expected. But good news was that wage growth increased more slowly. This means the overall trend is slowing, but it's still kind of high at 4.1%, and it's not slowing as much as the Federal Reserve wants. On the other hand, the household survey, which the unemployment rate is based on, showed a weakening labour market. Unemployment increased to 4%, the highest level since January 2022, and households said that employment actually fell by 408,000. Overall though, the market reaction favoured the establishment survey and took it as a sign that rate cuts would be pushed back. Why? Well, more jobs being added could add further wage pressures, and higher wages could be helping to keep inflation high, and it's also a signal that the economy is performing well, which once again could increase demand and lead to more inflation. Markets repriced rate cuts from 2 last month to just 1, but since then the market has repriced back to 2 cuts this year. So this shows you the kind of impact NFP can have on the markets. So what about this Friday's release? The 3 main data points from the release are going to be the headline number of jobs added, wage growth, and the unemployment rate. If this mixture looks strong, I wouldn't be surprised if the market reverted back to pricing in just 1 rate cut later this year. In terms of moving the other way, markets may increase bets on 2 rate cuts, but I think it would be a bit of a push to get to 3. There are only 4 more FOMC meetings this year, and it seems very unlikely that there'll be a rate cut at the next one, which is at the end of the month. Even if this month's NFP data is a knockout for rate cuts, there's also more data later in the month that we have to consider, primarily CPI and PCEPI. PCEPI is the Fed's preferred inflation rate, and it's currently 2.6%, while CPI is at 3.3%. Core inflation has also been sticky, and the Fed will want to see more progress on that before they end up cutting, something that they like to remind us about. So let's say on Friday the NFP data shows a slowing labour market, and then the CPI and PCEPI data also shows more progress towards the 2% inflation target, then I think we'll be in for more of a dovish tone at the FOMC meeting at the end of the month. While they might not cut at the next meeting, their tone could plant the expectation for a September rate cut, which is already being priced in, and then would get priced in even further. So that's why this week's NFP matters, as it fits into that puzzle of what to expect from the next FOMC meeting and the ones after that, and it's also the last release before that meeting, following a mixed report last time around. So if the data is strong, that could lead to the expectation of a more hawkish meeting, and the markets may reprice back to 1 rate cut this year, maybe even none this year. So the NFP release plays an important part in market expectations for monetary policy, and then attention will shift to the inflation data later in the month. It will play an important part for that September rate cut, or at least the expectation of it.